Hi everyone, it's Jab on another video, and today I'm going to be talking about not just a dividend aristocrat but a dividend king that is right near its 52-week lows and 50% down from its all-time highs achieved just 18 months ago, and that is Target. Fantastic business, over 50 years of consecutive growing dividends, 3.5% yield as of right now, significantly above S&P 500 averages, and trading at reasonable valuations, 17 times trailing earnings, right near its 52 low of $120 at just $125, and even after being cut in half, it's still up 41% over the past 5 years, losing to the S&P 500, but reasonably respectable in my opinion. So I'll analyse this stock a bit further, look at its valuation, look at its returns over the long run, how it's buying back shares, look at its most recent results and how it's resolving some of its issues, primarily around inventory. Those all-time highs were in the pandemic period where it was a great time to be running a retailer. Now it's got a bit tougher, they built up a lot of inventory and they're managing that problem, what I believe, effectively right now. And then I'll look at the balance sheet and decide whether I think this is a buy, sell or hold going forward. Looking at this table, which shows a number of valuation metrics for Target split up by year, you can see price to earnings, price to forward earnings and price to cash flow are some of the cheapest they've been since at least 2018, and versus the 5-year averages are significantly below. 5-year average for price to earnings is just shy of 19 on a trailing basis, currently it's around 17, and on a forward basis normally around 18, currently it's around 16. Not an absolutely staggering discount by any means, but significantly lower. 5-year average PEG ratio is split on 2.3, current predicted PEG ratio is around 0.76. Its potential earnings yield here of just under 6%. To me, this business looks reasonably undervalued, but not absolutely outstandingly undervalued when you take into account its problems and that this is a relatively low growth space, but I'd still be happy to pick up a 3.5% dividend yield in the meantime. Target is obviously a mature business and an established brand, and to expect incredible compound annual growth rates is really not what I expect from this business. We can see even over the last 20 years, when Target was absolutely still a mature and established business, the stock price has done incredibly well, in the region of 5x, if not more, and that's after halving in the last 2 years. The dividend payout has absolutely ballooned over 10x, absolutely outstanding over the last 20 years. This is while the shares outstanding are going down, and the yield has generally increased over that time, sitting around 3.5% right now, but the payout has rewarded shareholders incredibly well while receiving very, very strong share price appreciation, beating the S&P 500 over this period. So Target has proved as a strong track record over the last 20 years of rewarding shareholders by not only stock price appreciation but returning significant capital in the form of dividends. But not only this, they have returned significant capital to shareholders in the form of buying back shares. In the last 10 years, there's only 3 quarters where the share count increased, and in that time, share count has came down dramatically from around 650 million or just shy of that to just over 450 million now. That might seem like a lot, but that's a share count reduction of around a third in 10 years. That's absolutely outstanding and will have provided a massive boost to earnings per share. And there's some years where the quarterly share count has decreased by 5-6%. They've done really strong buybacks in the past when business has been booming. Right now, I would probably like to see more. I'd like to see the cash situation improving, the balance sheet improving, and then to be buying back more shares now, because it seems like an opportune time to be doing this when valuation is below 5-year averages, and also when historically it seems like a very good time to buy shares when the share price is low, when in 2021, 2022 they were buying back shares when the share price was quite inflated in my opinion, which is not the best use of capital. However, I still think it has been a net positive for shareholders over this time. The stock price reduction in this business has definitely been justified to some extent. I'm not sure if it should have been cut in half, but 100% this business's performance has not lived up to the valuation it saw in 2021 and 2022. In the most recent quarter, they saw a 5.4% decline in comparable sales, a 4.3% store comparable sales decline, while they have seen massive improvements on the digital side of the business in previous years. This year, a 10.5% digital comparable sales decline. Of course, they're coming off incredibly tough numbers. We're in a much more difficult economy right now with higher interest rates. People are perhaps looking towards some discount places or some cheaper alternatives, and a lot of target audience is looking at that discretionary spend and not necessarily all food. I guess the obvious comparison is Walmart, where it's predominantly food people are going for. Target has a ton of other things, and when people go there, they're typically spending a very, very high ticket numbers. And they're just not really seeing that. They saw a lot of accumulated depreciation because their inventory is kind of out of control. It still is really kind of out of control, but it is coming down. You see $15 billion of inventory in July 2022, January 2023, around $13.5 billion. And in the most recent quarter, around $12.7 billion. This is still too high, and it is the business has suffered as a result of this. This was the key problem for this business and why performance has come down. Because they're having to discount. This affected sales numbers, this affected EPS numbers, and while EPS was 358% higher year over year compared to Q2 2022, it's still not where it needs to be for this business, just $1.80 of GAAP earnings per share. Cash and cash equivalents is again kind of not really where we need it to be at $1.6 billion, but is improving year over year. Did come down a bit from January, but they did some share buybacks and bought some inventory, blah, blah, blah. All in all, this is an asset-heavy business. It has a lot of assets, also has a lot of liabilities, and the main problem was inventory, and it seems to be solving this, but the business performance, even against relatively tough comparisons, is just not quite good enough for me, particularly compared to peers like Walmart, who are doing a little bit better in my opinion. A major bright spot for this quarter was the 4.8% operating income margin compared to 1.2% in Q2 2022. They believe there was serious progress made, and that is undeniable really. Inventory levels are 17% lower than last year, which is a definite positive. In-stock levels improved from Q1 and the previous year, and they believe compelling price points have been messaged across the assortment, and this is reflecting in these numbers. Now, operating margin for this business has fluctuated considerably, but looking over the last 10 years, it's gone in one direction really. In the past year or so, it's absolutely not where it needs to be, and even 4.8% is quite low for this business. Tend to be seeing, on average, operating margins of between 6 and 7%, and this really makes a difference to this business's performance. You think these are very low margin businesses with incredibly high revenues, like Walmart, for example, over $500 billion of revenue, and a tiny margin. They're really splitting hairs there to get the margin, and it needs to be better optimized. This sort of fluctuation is unacceptable really, and is primarily because of those high inventory levels. You can see there was a serious uptick towards the end of 2022, and in 2023 it's still a lot of work to do in my opinion. This is by no means a complete story. They still have a lot of way to go. And again, just a final overview of the balance sheet. I don't want to really go into this in too depth, so pause if you want to see this. The highlight obviously being net earnings, 356% increase. That fed down to the same increase in earnings per share. However, off a very low base in the previous year where it was so significantly depressed. The low lights really decreased revenue at 4.9%. Cost of sale did decrease 11.6%, but they just made less sales, so it's not that impressive to me. Overall, this business is suffering, and while operating income, net earnings are getting better, inventory levels are getting under more control, and they continue to increase the dividend, which is obviously something we like to see. This is still an embattled business that is no means a perfect story in my opinion. The final kicker really, which caused a bit of a decline in the stock price, was the guidance was now looking a bit weaker. They're expecting $7 to $8 of earnings per share compared to a prior range of $7.75 to $8.75. Obviously, this put a down on this business quarter, and what was already a pretty downer quarter in my opinion. The only real bright spot being the operating income margin. I think this just shows, I think there's a lot of room for some of the share price to be shaved off, for a new 52-week lows to be achieved. I think Target could be pushing in the $100 mark before the end of this year, and I would be very happy picking up this business at around $100, maybe $110. I think given the problems this business is facing, and while it is turning around to some extent, I would like a greater margin of safety here than versus its historical valuations were at 17 trailing PE, 16.8, something like that, versus an 18-19 trailing PE historically on average. I'd like a little bit more of a margin of safety, maybe in that 15 range, 14, 13 on a forward basis. We're likely to achieve that around $100. I think it could get definitely close to this. Between 100 and 110, I will be looking very close to this business. It'll have a greater dividend yield, probably above 4%. I'll be very interested in this business then, because I do think over the long term, this could be a strong long-term compounder with a reasonably good future and a decent management team that lost their way a bit in 2021, as many retailers did, not just these, Nike, Walmart. Many retailers really struggle with higher inventory levels because of the mass amount of sales they experienced during the pandemic. They just didn't happen going forward. That being said, all this is just my opinion. I obviously think Target's a great business. They will do great over the long term. Right now, it's just not the price I'm willing to pay for it. I want more margin safety, but that's just my opinion. I'm not a financial advisor, so you shouldn't take this as financial advice. You should do your own research and due diligence, come to your own conclusions, and buy stocks that you want to buy. And of course, capital is always at risk. Like and subscribe if you enjoyed the video. Comment down below what you think of Target. I'll see you again next time.